Inflation is causing upheaval in the markets, making everything from gas and groceries to hotels more expensive. But just because the near-term economic picture is negative doesn't mean you should stop saving and investing. However, you may want to give your portfolio a once-over to see if you are positioned in the most recession-proof manner possible. No investment is completely immune to an economic downturn, and markets can always be unpredictable. But some investments are traditionally more resilient during difficult economic times. Today, I'm going to show you 10 investments that are recession-proof. Before the video begins, please give it a like, and if you want to see more, please subscribe to the channel. Now, let's begin. Number 10. Stocks. It's tempting to flee stocks and preserve wealth when a recession hits, but that may not be your wisest move. Even when the economy shudders, so-called recession-proof stocks are likely to continue generating returns. Others may lose value now, but if you hop in on the bottom floor, you can ride the recovery on the other side. Dividend-paying stocks. Quality dividend-paying stocks can provide extra passive income in good times and bad. But when a recession hits, you might look specifically for dividend aristocrats and dividend kings, companies that have paid dividends consistently for decades. Not only are they more likely to continue paying out during a recession, but they may see fewer or smaller price fluctuations than, say, growth stocks. This added stability can smooth over short-term portfolio volatility while bolstering your recession-era income. Consumer essentials and defensive stocks. Defensive and consumer essential stocks can further insulate your portfolio in rough markets. You can find these equities in industries that consumers directly or indirectly rely on, regardless of economic headwinds. Number 9. Bonds. Some investors consider bonds to be relatively safe investments during periods of economic instability. Generally, they offer guaranteed investment payments on a regular schedule until maturity, which can provide a lifeline during a downturn, particularly government bonds, which are backed by the US government rather than corporations. You can also choose from a range of maturities or even select bonds that pay interest rates pegged to inflation or TIPS for extra protection. And while bonds have taken a hit this year as interest rates have risen, that may not be a bad thing ahead of a potential recession. Lower bond prices now means a chance to buy in at a discount compared to future prices. Number 8. Cash and cash equivalents. Cash is a crucial component of most short-term investment strategies designed to protect and grow cash you'll need in under 5 years. While even high-yield accounts typically lose ground to inflation, the current high-rate environment may prove particularly fruitful in a potential recession. Number 7. High-yield savings accounts. As evidenced by the name, high-yield savings accounts generally pay higher interest rates than regular savings accounts. They also offer FDIC protection, literally insuring your cash against worst-case scenarios. With interest rates on the rise, they could prove a veritable safe haven in the event of an economic downturn. High-dividend stocks are riskier than FDIC-insured products like savings accounts and CDs. However, their potential for return is higher. During the market sell-offs that usually accompany recessions, high-dividend stocks may hold up better than others because investors are getting a cash return in addition to the potential stock price return. High-dividend stocks also tend to be more mature companies with significant cash flow in defensive industries, which adds another layer of protection against wild market swings. You can still lose money on high-dividend stocks in a bear market, but you'll be protected somewhat by the incoming cash payments and the high survivability of companies like this during recessions. Number 6. Certificates of deposit. Certificates of deposit, or CDs, also pay higher than average interest rates and offer FDIC insurance, but they differ from savings accounts in a few important ways. To start, CDs lock up your funds for a set period of time, ranging from a few months to over a decade. If you try to withdraw your funds early, you may incur a penalty. Additionally, most CDs pay a guaranteed interest rate until maturity. That means if you lock in a high interest rate now, your funds will continue to grow at that rate, even if market rates fall later. If you don't need your cash immediately, CDs can make a great place to stash funds during a recession or high-rate environments. You can even ladder your CDs to lock down shorter-term maturities on an ongoing basis until you're ready to cash out. Certificates of deposit are in a similar category to savings accounts when it comes to safety. Both are insured by the Federal Deposit Insurance Corp up to $250,000 per depositor. CDs typically pay higher rates than standard savings accounts and may pay as much or more than high-yield savings accounts. However, a CD often locks in funds for a set amount of time, so you won't have easy access to that money. If you don't think you'll need that money anytime soon, a CD can be a good place to ride out a recession and keep your funds safe until you can reinvest your money into investments with higher return potentials. Number 5. Money market accounts. Money market accounts generally pay higher interest rates than traditional savings accounts while offering similar check-writing abilities to checking accounts. They also offer FDIC insurance to protect your funds, though they may impose withdrawal or balance requirements. Their increased safety profile makes them an ideal recession-proof product for short-term or risk-averse investors. Money market accounts are another example of a federally insured deposit account, where you can trust that your money is safe. Money market accounts are typically semi-liquid hybrids of checking and savings accounts with limited checkbook access and modest annual percentage yields. Some online banks in particular have begun offering high-yielding money market accounts, and this can be a good place to hide out while you wait for the current economic and market uncertainty to pass by. Number 4. Yourself. In all of this, it's important not to undervalue yourself as a recession-proof product. Even if you lose your job or see your hours cut, you can invest in yourself by gaining new knowledge to get a better job or explore a new industry. You might consider taking work-sponsored workshops, online educational courses, or even teaching yourself a new skill like coding or painting. But investing in your career doesn't have to be your limit. You might put some effort toward aggressively paying down your debts ahead of a potential recession, especially with the specter of higher interest rates on the horizon. The less money you have to put towards bills in the future, the more security you'll enjoy during a crisis. Number 3. Rental properties. Housing as an investment isn't particularly recession-proof. In fact, during major economic traumas, housing prices tend to go down, although that hasn't been the case in the present downturn due to the effects of the pandemic on the housing market. But rental properties can still be defensive in economic recessions because of the passive income they provide. With record-high prices keeping many would-be home buyers out of the market, prospects for owners of rental properties could be especially good. The same caveats in choosing a rental property, such as being sure to choose an in-demand property in a well-located area and understanding the work and risks involved in owning a rental property, apply whether or not you are buying in a recession. Number 2. Precious metals. Precious metals like gold and silver are often in demand during stock market sell-offs and times of overall economic unease. The reason is that precious metals are seen as a store of value, something tangible that investors can physically hold onto, while their intangible assets, like stocks, go down in value. Gold also tends to rise during low interest rate environments. Since gold doesn't pay a dividend, it becomes more attractive when other instruments are not paying much income either. Number 1. Grocery stores. Grocery stores run on thin margins, which can make them tricky investments. During recessions, however, grocery stores often have an uptick in sales and profitability. As consumers trim their spending on eating out at restaurants, they tend to buy more groceries and eat at home. Even during the bleakest of recessions, people still need to eat, and grocery stores provide this necessary service in a more affordable package than restaurants. Thank you for watching, and please hit the like button, subscribe to the channel, and enable post alerts to view more of our future videos. After saying that, keep watching our videos, and I'll speak with you in the next one.